Okay, so the recording has been started. This is Professor Anak Haraituta here. Welcomes you all in the class of Financial Mathematics. Everyone, please open your book and pen. And before I go to the conceptual understanding of the concept that we are going to do today, we will have one little experiment with us. And from that, we will go to the conceptual understanding. How? Let's see. And even before that, I would like to welcome Professor Bhumika Achnani, ma'am, who is a senior colleague of mine who has joined as a guest uh, for this session. Welcome you, ma'am.
Thank you,
Uh,
sir. Thank you.
yeah, and everyone, just give me a confirmation. Is it properly audible or some voice is breaking or something like that? If you can just
Audible,
give me
sir.
in
Audible,
the
sir.
chat box. It's audible. No? Thank you very much. Okay, sharing my screen with all of you. Thank you very much, Chandni. Very proactive. Okay. My screen must be visible to everyone. Just give me a 1 second. I need to open my Brahmastra. Where is my Brahmastra, the pen which I use? Just give me a 1 second, everyone. Yes, I have got it. I can see that 12 students have joined, 11. Miss Creamy, can you hear me? Can you give me a confirmation by unmuting yourself? Thank you. Creamy, let me tell you one thing, that you are not being attentive to the classes. I see that you are not putting the efforts in learning. From last so many days, I have seen the rude behavior from your side. You are not doing well in my class. What is the reason behind it, Creamy? Can you tell me? Yes. Am I talking to Creamy? No answer for Creamy yet? Or she is typing? Sir, I'm attending. Okay. Properly as well. Okay. Mr. Yash Agarwal, can you hear me? Give me a confirmation.
Yes, sir.
I can see in your behavior as well that you are not attending the classes properly. You are not putting the focus into the studies. You are not understanding the things well. Still, you are not telling it to me that you are not understanding that. Why? Do you have an alternative opinion? If you have, then let me know.
No, sir. Only last two lectures I have not attended.
I didn't know that. So I have come to know that now. Okay. Let me go to Miss Vidya. Vidya, can you hear me?
Yes, sir.
Vidya, you didn't submit the assignment on timely basis last time around. I could understand that. Why?
No, sir, I had submitted at time.
You had submitted at time. I don't think
Yes,
so.
sir.
Did you
Yes,
submit it at time? No, I don't think so. Why you are laughing? I am very serious, pretty serious right now. You are laughing. Did you submit on the time? Yes or no?
yes, sir.
Yes, sir. Okay. Now, others who have observed this, we have asked the same question to Miss Vidya, to to Mr. Yash, and if I'm not wrong, I have asked the same question to Miss Creamy as well. Now, I want to know it from you that who was more reactive. K stands for Creamy here, then V stands for Miss Vidya here, and Y stands for the Mr. Yash over here. Who was more reactive? When I asked this question, now let me please clarify this. There is no need to take it in person. It was just an experiment from my side to know that who is more reactive. Based on the answers and observations of this, we are moving to the next concept of finance today. Who was more reactive? Can someone tell me? The others who have observed this. Bhavya, why? Mr. Y was more reactive. Okay, Chandni is also of the opinion that Mr. Yash was more reactive. Mr. Sagar is also of the same opinion. Good to see that. Anyone else? Acha, to all those to whom I have asked the question, V was more reactive. Vidya was more reactive. Okay. So 3:1, we have the votes right now. 3 in favor of Mr. Yash and 1 in favor of Miss Vidya as far as the reactive and sensitivity is concerned. Anyone else would like to share their opinion? Would like to give some observations out of this? They are most welcome. Okay. Now, if you majority of the opinion, if we take, no, then people are saying that Mr. Yash was more reactive. Then in second number, we can say Vidya was also a reactive. We may have a competition between the two. Say, let me put Vidya at second rank. And Miss Creamy was little less reactive. When I put her in a situation, in an uncomfortable situation, she was little less reactive. She couldn't first understand that how to reply, what to reply, and little bit confused as well in giving the reply, right? Now, from this, everyone should be able to understand that if anyone is put into the same situation, in the same circumstances, into a similar kind of a climate, our reaction in the same circumstances might be different. हम सब एक ही सिचुएशन के अंदर अलग अलग तरीके से रिएक्ट करते हैं. मैंने सबको इक्वली रूड टोन के अंदर बात की, मैंने सबको सिमिलर सिचुएशन के अंदर रखा, मैंने सबको सिमिलर वे में ट्रीट किया, लेकिन हर एक का सेंसिटिविटी था, हर एक का रिएक्शन था, वो अलग अलग था. Some of the students were highly reactive, some students were not that much. Some students were very stable in their behavior, in their nature. They couldn't react much. Similar sort of a thing happens with the securities. If I give you a very simple example, everyone is aware about this infamous market crash that has happened after this corona outbreak. The market was down like anything. It was down by around or almost 40 to 50% of its previous value. But if you can observe from that, 40 to 50% that we see in the market, no, after the corona, within just a week or so, some of the stocks were reduced only by 10 to 20%. But some securities got down by, if I give you the example of say PVR or some of the securities like Reliance, that got down by around 60-70%. Some of the banks, if we see ICICI Bank, IndusLand Bank, banking and financial sector, that was the most affected sector. That was down by almost 80 to 90%. Banking companies were down by 80 to 90%. Well, all were there into a similar type of a situations. All were put into a similar kind of a circumstances, but everyone's reaction to that situation and that circumstance was different. Some were less reactive, some were highly reactive. Now, obviously, those who are falling into this category, which are less reactive, less sensitive to the changes, are those people who are very stable in nature as far as the behavior and their sensitivity is concerned. Similarly, these stocks are stable in nature. They react less as compared to the overall market. This is my overall market. And these people react more as compared to the overall market. These are called highly sensitive stocks. Now the next model that we are going to study, that is the capital asset pricing model. Now capital asset pricing model takes this analysis into an account. It says that you cannot expect the similar type of a return from every stock. Your expectations from the each and every stock will be different based on the sensitivity which they have as compared to the overall market. Can someone tell me what is the statistical indicator we have to know the sensitivity of the stock? I know you people are aware about it. You have studied that as well. You must have done the numerical mathematical calculation of that as well. But still I want to know if you can identify that. What is the statistical parameter we have to know the sensitivity of the stock, to know the reactiveness of a stock, that how that stock is reacting to the changes in the market? Can someone tell me? Anyone? Absolutely correct, Miss Sneha. It's beta. Standard deviation, Miss Chandni, is the parameter of the volatility. Yes, you may tell it as a parameter of reactiveness as well, but as far as the perfect sensitivity is concerned, that if you move market by 1%, what would be the direct effect on the stock? For that, beta is something which gives us the better results. Now based on the beta, the expectations from the each company shall be different. Okay, let's go to another example in the similar lines. Please try to understand that now. Okay, say we have one stable stock, Creamy Limited, and then we have one very highly sensitive stock, Mr. Yash Limited. These are the two companies. यश के तो नाम है में ही कुछ ऐसा है जो सेंसिटिविटी को रिफ्लेक्ट करता है, यश एंड यस बैंक एंड oops. Okay, now let's take the example of various years now, starting from say 1 year, second year. I'm not giving the exact name to the years. 3, 4, 5, 6, 7. Now you had invested in both the stocks at 100 rupees, and in the year number 2, the stock went down by 95, then it went down by 85, down to 85, sorry. Then in fourth year, अचानक से इसको कुछ, no, it was a stable stock. Just give me 1 second. Just give me 1 second. Just give me 1 second. Okay, it went up by 102. Then it was 104. Then it went in 10 to 107 in year number 4. Then in year number 5, it went to 111. Then in year number 6, something like Corona happened, and the prices of the stock, went down a bit. Say it reached to 107 again. And then in year number 7, after the great recovery, the immense recovery we could see in the market, it reached to 114. Okay, so that is the price pattern we have observed for this particular stock over this number of years, these periods. But then there is a Yash Limited. Oh my God, so much reactive, so sensitive. सर मैंने ऐसा कुछ किया ही नहीं है. आप मेरे ऊपर ब्लेम कैसे कर सकते हो कि मैं अटेंड नहीं करता हूं? मैं तो सब कुछ करता हूं. Okay, so it went down by 90 to 90. Then अचानक से 105 हो गया. फिर वो फिर से पता नहीं क्या हुआ उसको, ईयर नंबर 4 में कुछ तो नेगेटिव न्यूज आ गई मार्केट के अंदर और वो 85 पे पहुंच जाता है. फिर नेगेटिव न्यूज को रिमूव करने के लिए डायरेक्टर्स ने कुछ ऐसा रिएक्ट किया और स्टॉक के प्राइसेस फिर से 115 तक पहुंच गए, फिर 108 पे गए और फिर से प्राइसेस ईयर नंबर 7 के अंदर 120 पे पहुंचे. Now, can someone tell me from this pattern which stock is more risky? Whether we have Miss Creamy Limited or Mr. Yes Limited, who is more risky? Yes, Miss. Now I have a great confusion related to the Mr. Miss and Mr. Bhavya. I guess Kamdar is a boy, right? Bhavya Kamdar is a boy. Okay. So Mr. Yash is saying Yash is more. Creamy is also saying Yash is more. Mr. Sagar is also of the same opinion that Yash is more risky. Now, if you want to invest in a stock, in which one you will invest? Can someone tell me? If you could just give me a reason. See, in both the cases, your investment amount was same. You had invested 100 rupees in either case. But at the end of the 7th year, you could see that 114 rupees were there for stock number Creamy and 120 rupees was there for stock Yash Limited. In which you would like to invest and why? If you can just give me a logical reason behind that. Everyone, take your time, giving you 30 seconds just to observe the pattern. It's perfectly fine to unmute yourself as well. I'm not going to judge you based on the answers you give me because I know that even I was there at your place some years back. There is perfectly no problem. There is absolutely no problem if you just give a roundabout answers. That's fine. Everyone, and others who are little introvert and shy, those people would be like, sir, I'll be answering the chat box only. Okay, you can. Okay, may I have the answers now? Okay, so Miss Creamy is of the opinion that Creamy Limited is stable, so that's why the possibility of loss is very less in that, and I should invest in that. So Creamy is taking the name of Creamy Limited, as the name itself suggests. Someone else. Mr. Bhavya is of the opinion that Yash Limited is something where he or she should invest. Okay. If I can take a risk in my future analysis, good to see that. So risk is the word which has been highlighted in Mr. Bhavya's answer. Okay. Miss Neha is of the opinion that to speculate, Yash Limited is good. Speculate might not be a very appropriate word to use just because of the fact that this stock is more risky and more volatile in nature. You may not say, we cannot say that it is more speculative. Speculative, you are there in the right direction, but there is a thin line of difference between a speculation and investing into the risky stocks. Some of the stocks might be very good fundamentally in terms of ratios and financial information, but even after that they might be very much risky. If I can give you the example of the some of the banking companies, they are strong fundamentally, but if we see historically, banks are some kind of stocks which reacts much as compared to the market. So if the market would be down by 1%, they would be down by 2%. Okay, so people have the different opinions. Those who are saying that we should invest in the Yes Limited, their primary argument is that they are able to earn more return out of it. They invested 100 rupees, but they are now getting 120 rupees, even if they could just remain invested during all this number of days. But if you can identify the entry and exit points in this stock, and if you can see that by doing your own analysis, if you can understand your entry and exit point, if you would have invested at 90 and You kept your investment out of that stock at 105, so you have earned 15 rupees over here, right? Then again, you were smart enough to identify your entry point. At 85, you are of the opinion that, sir, this stock is highly undervalued, we should invest in that. Again, you had done the entry at 85 and you sold it at 120. So you could earn the humongous profit of, say, 35 rupees again in that. And in totality, your profit was 50. Your total profit was 50 if you had done the investments for twice. If you could identify your entry and exit point properly, if you could identify that what is the overvalued amount and which one is the undervalued amount as far as this stock is concerned, you could have made a huge amount of profits from this stock. The first stock is something in which you doesn't lose your money much. But at the same time, it also does not give you a good amount of returns. It does not provide you the good entry and exit opportunities, because this is moving in a very similar kind of a direction. Even if something is happening, it is reacting very less as compared to the market. So what I'm trying to say from this is, the one which is having the too much of volatility and the one which is having the less volatility, obviously the return expectations would be different. The return expectations of yours from this stock will be stable, and the return expectations you have from another stock will be slightly high. Not slightly, in fact, much more high, comparing the volatility we have here for these two stocks. You have a high return expectations from this. Now, this is not something which is said by the book theoretically. No. It is the investor's behavior. Investor will expect more amount of return, more percentage of a return from a thing which is volatile in nature, because that fellow is taking the risk. Here his capital might go down like anything. Say, if you are able to identify your entry and exit point, then you are making the good amount of profits. But if you couldn't identify that, some people can be there who might have done the entry at 100 and they would have sold it at 90. If the risk taking capacity is not much, they would be like, oh no sir, अब 90 से नीचे तो जाना ही नहीं चाहिए, और नीचे चला जाएगा तो मेरा पूरा ये चला जाएगा, चलो 90 पे सेल करके निकल जाते हैं. 10 रुपए का लॉस कर दिया. Understood that this gives you the good amount of return, but there is a risk as well. There is an equivalent chances of making the loss too. If you would have done the entry at 105 and at 85 you couldn't survive, that is the 20 rupees of decrement. If you couldn't put the horses of your nerves and pulses under a control at that time, at 85 you would have solved that investment. And obviously any rational investor would at least put a thought that whether I should still remain in the stock or not. If I have invested at 105 and if I am leaving that stock at 85, and if that stock is right now having the value of 85, that is a 20 rupees down as compared to my purchase cost, I would think that it may further go down. Now, these decisions are based on various aspects: your risk-taking capacity, your return expectations, the historical performance of that stock, the fundamental indicators, the technical analysis, hell lot of things. But at least one thing we can identify from this example, that your expectations of return is different based on the sensitivity of that stock. The one which is highly sensitive, you expect more from that because you are taking the risk. And there is a thumb rule of the finance that higher the risk you take, higher would be the chances of return. Obviously, why anyone would take the risk? If anyone is taking the risk, he or she is taking the risk with the expectation of more percentage of a return. Now, taking this investor's psychology, Some of the professors, the highly educated professors, developed the model called capital asset pricing model that tells you, let's try to understand the explanation given by that in a simplest manner. It tells you that any investor will expect at least at least 1% of a return which is available in risk-free assets. Now, what can be the risk-free assets? Risk-free assets can be like government securities. Government doesn't go bankrupt, right? कभी सुना है कि मना कर दिया, पैसा नहीं देना है, चलो निकलो? कभी गवर्नमेंट ने से बोला है? नहीं बोलती. So in government, you do not have too much of a default risk possibilities. Government doesn't go bankrupt. So government securities which are there in the market gives you the risk-free rate. It can be a public provident fund. It can be government bonds. It can be some of the schemes of government where you invest. So any investor will expect at least that percentage of a return which is provided by the risk-free securities. So I can call it a risk-free rate. Obviously, in any stock, any security, you would expect this kind of a return, right? उतना तो मिलना ही चाहिए. और उसके पीछे का दूसरा और भी रीजन है ना, मैं इतना ज्यादा मगजमारी करूं सर, मैं रिस्क का इतना ज्यादा रिस्क लूं, मेरा कैपिटल लूज हो सकता है, अगर स्टॉक 20-20, 30-30% डाउन हो जाए तो मुझे शाम को नींद नहीं आएगी, मुझे डिप्रेशन की गोलियां खानी पड़ेगी, मुझे कितना ज्यादा, और फैमिली का सुनना वो तो अलग से बात है. अब इतना सारा आप प्रेशर लेते हो अपने ऊपर पे और आप रिस्क फ्री रेट जितना भी अर्न नहीं करते हो, तो फिर क्या मतलब हुआ उसका? एटलीस्ट इतना तो मुझे एक्सपेक्टेशंस होनी चाहिए. ऐसे मजे करते करते बैठे ऐसे सोडा पीते पीते फिक्स डिपॉजिट मुझे 7-8% का रिटर्न देती है विदाउट टेकिंग सिग्निफिकेंट अमाउंट परसेंटेज ऑफ ए रिस्क. So at least a risk-free rate is the expectation every shareholder will be possessing from that particular stock. But obviously they are taking the risk, so they should get some risk premium, right? Now let's try to understand my argument properly. I'm using the word risk premium. It is the premium you get for taking the risk. Now, what is the premium you get for taking the risk? Can someone tell me? If you can. What is this risk premium? How can we calculate this? If you can just, run the horses of your intellect, आप थोड़े से गेस करके सोचो, आप क्या हमारा रिस्क प्रीमियम क्या हो सकता है, कैसे कैलकुलेट कर सकते हैं इसको? Anyone? Good to see that attendance has increased by many folds, but thing is that when I was there in the initial part of the lecture, many of the students were not joined there. So my humble submission to all the students to join on timely basis, because उसमें तेरा घाटा मेरा कुछ नहीं जाता if you are not joining on the timely basis. Can someone tell me what can be the risk premium from any stock? Mr. Sagar, Mr. Yash, Miss Creamy, Miss Neha, Miss Ishita, everyone. That's fine. I mean, guessing it's perfectly fine. No need to worry about it. एकदम 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 ऐसा एंड वाला आंसर दोगे ना तो भी चलेगा, एक्सट्रीम वाला जिसका कुछ रिलेशन ही नहीं है. बोलना जरूरी है, आंसर का इंपॉर्टेंस नहीं है क्या देते हो. डू नॉट वरी, आई एम नॉट समवन हु जज यू बेस्ड ऑन योर आंसर्स. Okay, Miss Neha is Sagar, we have got the answer. Bhavya Kamdar, we have got the answer. Okay, from Sagar we have that by subtracting the risk-free return. Yes, you are there on right on the track, but from where we should subtract this risk-free return? Miss Neha is of the opinion that expected rate of return minus risk-free rate of return. Absolutely correct. Now, what is that expected rate of return from any stock or from any market? Good to see that. Good to see that you people are right on the track. Then we have Bhavya Kamdar as well. Expected to yield in excess of the risk-free rate. Absolutely correct answer. Okay. Now, what is the expected rate of return from the market? That we should see. Now, say expected rate of return from the market is RM, that is return from the market. As it has been stated by Ms. Neha as well as Mr. Bhavya, that it is something, the risk premium is something which you earn in excess of the risk-free rate. So, market return minus risk-free rate. So, that is the excess which you earn from this stock. That is also called as risk premium. So say expected rate of return from the entire market of equity is 15%. Then my expectations, my risk premium shall be 15 and risk free rate is 10%. Then 5% at least I should get as a premium. But my next question, again, you people are deriving this model. I am absolutely happy to see that. Now, can we have the similar type of expectations from the every company? Can we expect, because if you do such kind of a calculation, no, then the risk, then this, expected return from the every company would be same. Risk-free rate plus RM minus RF. So what is the one indicator which separates the companies, which differentiate the companies? We have just discussed it. If you can let me know. Very true, Miss Neha. Miss Neha has cracked it like anything. We may have a digital round of applause for her, even for Mr. Bhavya. It's beta. Your expectations from any company would differ based on the beta category in which they are falling. Beta is the parameter of sensitivity. Now I am coming to the concept of beta. I hope you have understood the logical, systematic derivation of this model. Your expectations from the stock is at least the risk-free rate which any asset class is giving to you. At least that much of an expectation you have from that stock. Over and above, you should get some risk premium because you are taking the risk in terms of your default risk, in terms of losing your capital, in terms of so many other things. But the same calculation does not apply in the blanket manner, in the umbrella fashion to everyone. Because that expectations from everyone would be different. There is one parameter which differentiates that, and that is the beta. Because some stocks are highly sensitive, some stocks are less sensitive. Some of the stocks like Creamy Limited were highly stable in nature. You will not put so much of an expectation in terms of a beta over there. But if some of the stocks are there like Mr. Yash Limited, having the high beta, your expectations would also be very high. So बीटा का अगर सिंपल वे में हम इंटरप्रिटेशन करने की कोशिश करें तो it is the sensitivity of a stock as compared to the market. Say if the beta is 1.2, the very simple meaning of this 1.2 is if market will go up by 1%, this is market, this is my stock, then this stock will go up by 1.2%. Say if beta is 2, again a very simple understanding, and the beta of market will always remain 1. Let's put this in the back of your mind. The market in which we are investing, which consists of this, risky securities, say for example Nifty or Sensex, the beta of that particular market or of that particular portfolio of the various assets will remain 1. So if I say one company's beta is 2, a very simple interpretation of this is that if market will go up by 1%, this company's stock will go up by 2%. Now, this does not apply only to the profits. Please try to understand that. This applies even to the losses. When the market will be down by 1%, this company's stock will be down by 2%. This is the sensitivity, highly sensitive stock. Now, based on the, have you got the interpretation of this beta? Should I explain it further? Yes, I'm coming to the statistical, derivation of this beta. We'll go to the formula of that. It is nothing but one regression slope. I'll come to that. Please do not go over there right now, else you will get confused. यहाँ पे इंटरप्रिटेशन में आपको मालूम पड़ा कि उसको कैसे इंटरप्रेट करना है. If market is going up by 1%, this company stock is going up by 2%. If there is a beta of say 0.5, so it is less sensitive as compared to the market. So if market is going up by 1, this company's stock will go up by just 0.5. And in the similar, and the similar type of a behavior we'll see when there would be a losses. When market will be down by 1, this company's stock will be down by 0.5. So this is a parameter for the stability. This is the parameter to understand that how reactive the stock is. Is it clear now? Anyone having any confusion till now? If you have, just let me know. As I repetitively state in my class, that the one who asks a foolish question will remain a foolish for a one time, but the one who doesn't ask a question will remain foolish for the entire life. You decide. For one instance or for the entire life. Have you got it? Surely. Give me a confirmation, positive or negative, anyone. All of you. I hope you have got this information. And the silence shall not be very perpetual in nature. I hope my students will break this silence. Oops. Giving you 30 seconds to observe this again. Let me know if you are stuck somewhere. Yes, Mr. Bhavya, I absolutely agree to that, that beta has some of the shortcomings. Beta is not something on which you can rely entirely. Beta is not something which gives you the idea about the fundamentals of the company. Beta is not something which gives you the overall picture of the company. Beta is not something which gives you the idea about how the stock will be performing in the future. Yes, I accept every such kind of a criticism for the beta. Beta is having the limitations, I know this. But see, when you expect from any stock, this is to find the expected rate of return from a stock. When you expect the return from a stock, you take some historical base. Now, if you try to understand that what kind of a historical base you can take, because obviously your prediction is also dependent on the history, right? History is something we assume in the finance that history is something which will be repeated in the future if everything will remain same or constant. Majority of our analysis is based on the historical data. So we assume that how the stock has reacted in the history, the similar kind of a reaction we might see again in the future after adjusting certain other events. Now, your current position, your present is judged by your history, not by your future potential. Please try to understand that. The investors who are investing into the company, obviously they see the future potential instead of, historical base. But if we try to put any kind of a statistical understanding of, a mathematical, numerical understanding of any sort of a things, we take history into the account. Even in the prediction, we take history as a base. So how historically that stock has reacted to the market changes, that can be taken for, for the purpose of getting, finding the expected rate of return from this particular stock. I know, absolutely, I agree to this, that it is not the the perfect parameter to judge this. There are n number of other things as well. You cannot expect from a stock just purely on the basis of beta. I agree to that. Is it clear now, Mr. Bhavya? Is your doubt is clear now? Good to see that. Thank you. Okay, so when the beta of any company would be high, obviously the expected rate of return from that company would be high. So if I give you the example of some of the stocks, say risk-free rate, and risk-free rate can be taken, as a percentage of return you get from the government bonds. Some people might take the fixed deposits as well, but I do not put fixed deposit nowadays into the risk-free asset classes, just because of the fiascos that have happened to the Yes Bank and some of the other things as well. So there is no absolutely clear cut explanation given for this risk free type of an asset. It is an asset where you can get this particular return without taking much of a risk, in fact nil risk. Okay, so say if the risk free rate is 10 percentage and the market rate is 15 percentage, this is the return which historically entire market of security has given to you. It can be a Nifty, it can be a Sensex. Now say if beta is 1.8, now what will be the expected rate of return of that company? Say this company is A Limited. By taking this capital asset pricing model into account, we may find the expected rate of return. We may also call it a KE, that is cost of equity for the company. The expectations of equity shareholders from the perspective of investor will be the cost of equity from the perspective of the company. For the company, it is a cost. For you, it is an expectations from the company, right? So KE equal to risk-free rate, that is 0.10, plus beta is 1.8, in bracket 0.15 is the market return, that is RM, minus RF. This is the risk premium. So minus 0.10 in this case. So can someone calculate this? 0.10 plus 1.8, in bracket you will be having 0.05. Can someone give me the answer of this, the final answer? Yes, I can do it. Excel gives me the answer in a fraction of minute, but I do not want to do it. I am the professor. मैं क्यों करूँ? चलो तुम करो सब कुछ और मुझे आंसर दो. Can someone give me the final answer? Miss Neha. Everyone giving you some enough time to do that. Good to see that. 0.10 plus 0.09. Adar Panchanevu, so it would be 0.09. Some people would be like, sir, what is Adar Panchanevu? We are the Gujarati medium students, so we calculate like this. I'm sorry. So this would be 0.19 over here. So that is the expectation of this stock. Now say if the beta is less, say beta is just 0.5. So what will be the, instead of 1.8, we have just 0.5. So KE shall be 0.10 plus 0.5 in bracket. The risk premium we have, that is 0.05. So what do we get? 0.10 plus 0.025. Some people would be using the calculator even for such kind of an calculation. No, though we have the calculators available now, but we should not be using in every circumstances, please. 5 5s are 25. Even a layman can do this. So we can have a 0.125. So in percentage form, we may have 12.5% return expectations from this. And here we may have 19% of the expectations of return. So the expectations of the return can be found by taking the beta into as a base and by using the capital asset pricing model. Now, next time onwards, we will go to this calculation, that is how to find this beta now. So our next task in the next lecture would be finding the beta by using some statistical regression slope formulas, and based on that we will again conclude on the requirement of the sum, that whether we should invest in that company at that particular rate of return expectations or not. So those kind of sums will be there in the next lecture. Is anyone having any doubt or any query in understanding the capital asset pricing model? If you have, just let me know, else I'm assuming that my students have got it. Everyone, because silence will be taken positively, right? I am an optimistic person. Those who are not replying, I would obviously assuming that they have got it. Okay, Yash Chomal sahab jaag gaye hai. Yes sir, good to see that. Where were you, Yash? I couldn't see you initially in the beginning of the lecture. Vidya has given the affirmation as well. Miss Shivangi as well. I was always here sir. Yes, do not. यश झूठ मत बोल, मैंने देखा है, शुरू में नहीं था तू. बच्चे मेरे सामने ऐसे बोल रहे, बोलो I was always here. Anyway, just kidding, but please try to be on timely basis. A humble submission to everyone. Okay, so let's have a rapid fire revision within a 1 minute, and then we are going to complete this class for the day. There is a capital asset pricing model. The capital asset pricing models gives you a mathematical relationship between the risk-free asset as well as the expectation that you should have as a terms of risk premium. But the risk premium expectations from the every company cannot be similar. It would differ. It would differ based on the sensitivity which they have, and the sensitivity and the reactiveness of that stock can be found by using the concept of beta. We are still not into the calculation of the beta. That will be taken in the next lecture by applying some statistical tools over there. So this is the formula that we had derived: risk-free rate plus beta in bracket RM minus RF. So this is the capital asset pricing model. We have also understood the investor's psychology behind it. We have also taken the logical understanding of that. In the next lecture, we may go to the numerical sums on this. So that's it from my side. Thank you very much. Do not leave the class because now I'll have to take the attendance.